Welcome to Looking at the Markets with me, David Modell. Today we're going to talk about a couple of options, strategies that people ask me about sometimes. The question today is, should I buy straddles or strangles? So let's talk about that. Expecting a big move? If you're expecting a big move in a stock or ETF, commodity, currency, etc., but you don't know whether the big move will be up or down, then you might be considering buying a straddle or a strangle. Just to review, a straddle is where you buy a call and a put with the same expiration date and for the same underlying equity and with the same strike price, usually at the money. A strangle is the same as a straddle, except the call and the put have different strike prices, and usually out of the money. So why do this? The big advantage of buying straddles and strangles is the fact that you don't need to predict whether the stock will move up or down. As long as it makes a big move within a fairly short period of time, you can profit. But there are some serious disadvantages. Not needing to predict whether a stock will move up or down probably sounds great, right? However, there are some disadvantages. Straddles tend to be expensive. Remember, you're not just buying one option. You're buying both a call and a put. So if the stock doesn't make a big move in a fairly short period of time, you can lose more money since you paid for two options. Strangles tend to be less expensive than straddles, since the options are, generally speaking, out of the money. But that also means that you'll need an even bigger move from the stock within a fairly short period of time. Thus, your chances of succeeding are even smaller than they are with a straddle. And they often don't work as planned. People tend to buy straddles and strangles when implied volatility, or IV, is low, and or when the Bollinger Bands squeeze or contract. The hope is that the low volatility squeeze will soon be followed by a higher volatility or a big move. However, the move often doesn't happen soon enough, or it might not be big enough, or both actually. So, for example, we're looking at a chart of XLE, which is an ETF that represents the energy sector. Now here's an example of low implied volatility, and so you've got a Bollinger Band squeeze or contraction here, followed by a big move. Okay, so if you had purchased a straddle or a strangle right here, yeah, you might have done pretty well. However, doesn't always work out as planned. A lot of times the Bollinger Bands will squeeze and not be followed by a big move. So as you can see, if you had purchased here, you might not have done so well because XLE continued to stay within a tight range. Moved up a little, down a little, up a little, down a little. So the Bollinger Bands squeezed here, but they stayed squeezed for a long time. In other words, there was no big move for a long time. And time is not on your side. Day after day, you've got time decay deteriorating both your put and your call. It's almost like you've got double the time decay losses when days go by and there's no big move. So you really need a sizable move soon after you buy the straddle or strangle. And again, if you bought it here And maybe here you were hoping for a big directional move. Nope, doesn't happen. And you're hoping for it here. Nope. You're hoping it'll go way down here. Nope. And so every day it's like an ice cube melting, both your put and your call. And so every day, tick tock, time's going and going, and your straddle or strangle is losing value because the underlying equity or asset is just not moving one way or the other big enough or soon enough. Expensive prior to big events. Yeah, if there's a big event coming up soon, such as an earnings report or a Fed announcement, option prices, both puts and calls, are inflated because people are expecting a big move to possibly happen soon. So straddles and strangles become even more expensive than usual prior to these events, making it even more difficult to achieve a profit. So what's the takeaway? Well, personally, I don't typically buy straddles or strangles. You might want to consider more economical alternatives with better odds of making a profit. So if you'd like help with options or stock strategies, or with finance in general, I can certainly assist you with that. If you need help, feel free to contact me, David Modell. My email address is davidmodell@gmail.com. And by the way, I'd like to dedicate this video to my girlfriend, Wendy. Hi, Wendy, how you doing? And also, if you like this video, I hope you'll feel free to give it a thumbs up or leave comments. The comments let me know how I'm doing. And if there are topics you'd like to know about, you can also leave that in the comments. Or again, you can email me anytime. Thanks a lot, and I hope to hear from you soon.